There is a profound, almost suffocating psychological whiplash taking hold of the global economy right now. We are in the final weeks of March 2026, and a very dangerous, intoxicating narrative has just collided violently with cold, undeniable mathematical reality. For the past 18 months, the financial media, Wall Street analysts, and politicians have been selling you a comforting story. They told you to just hold on a little bit longer. They promised that the Federal Reserve was about to pivot, that interest rates were going to plummet, that inflation was a conquered beast, and that the era of free, easy money was about to resume. Millions of hardworking people believed this story. They stretched their budgets, they kept their 24% credit card debt floating, and they bought wildly overpriced assets, assuming that a sudden wave of cheap credit was going to wash over the economy and bail them out. But over the last few days, the architecture of that illusion has completely fractured. Look at what just happened. The Federal Reserve concluded its March meeting and held the benchmark interest rate absolutely steady at 3.50% to 3.75%. Why? Because of a massive geopolitical shock. We are watching a sustained conflict unfold in the Middle East. Brent crude oil just surged past $116 a barrel, completely shattering the timeline for any immediate rate cuts. The central banks are caught in a terrifying trap. Job growth is weakening, and we just watched the Russell 2000, the index tracking small-cap companies, plunge straight into correction territory, dropping more than 10% as these smaller businesses suffocate under the weight of higher borrowing costs. The pressure to cut rates is immense, but inflation does not disappear overnight, and this new oil shock has embedded it even deeper into the supply chain. Wholesale inflation just jumped 0.7% in a single month, and the Fed was just forced to raise its core PCE inflation projection for the end of 2026 up to 2.7%. If they drop rates now to save the stock market, the cost of living will explode into the stratosphere. And because they are caught in this stagflation trap, you, the average worker, the saver, the consumer, are becoming the collateral damage. I have spent the better part of 8 decades analyzing the machinery of global capitalism. I have traded through the inflation spirals of the 1970s, the euphoric delusions of the 1999 dot-com bubble, and the devastating credit collapse of 2008. The faces change, the geopolitical catalysts change, but the underlying mechanics of wealth transfer remain exactly the same. What we are witnessing right now is a monumental reality check. The market is suddenly waking up to the fact that the rules of the last 15 years are dead and buried. Today, we are going to have a brutal, unapologetic conversation about the reality of your money in 2026. I am going to tear down the mirage of the modern economy. I will expose the 5 specific financial illusions that are bursting right now. And then I am going to give you the exact unyielding protocol that the truly wealthy are using to shield their fortunes from this volatility and systematically acquire the productive assets of the world while everyone else is panicking. This will be a dense and demanding masterclass. It requires you to silence your emotions and look at your balance sheet with clinical objectivity. But if you have the discipline to stay with me, you will completely rewrite your financial destiny. Let us begin by dissecting the current environment. We must expose the 5 illusions of March 2026. The first illusion is the mirage of the rate cut rescue. The entire middle-class strategy for the last 2 years has been based on procrastination. People are carrying variable rate mortgages, massive auto loans, and staggering credit balances because they are convinced that interest rates are going to drastically fall by the summer. They believe that if they can just survive for a few more months, Jerome Powell will slash rates, their monthly payments will drop, and their financial anxiety will vanish. This is a fundamental misunderstanding of macroeconomic history. When energy prices spike and inflation is structurally embedded into raw materials and transportation, it does not simply vanish because the market wants it to. Oil dictates the price of everything from shipping to fertilizer. Furthermore, Kevin Warsh is preparing to take over as Fed chair in May, bringing an entirely new dynamic to the committee. The cost of borrowing money must remain elevated to fight this structural inflation. If you are sitting on high-interest consumer debt, waiting for the Federal Reserve to save you, you are committing mathematical suicide. You must realize that nobody is coming to rescue your balance sheet. The era of 0% interest rates is a historical anomaly that has definitively ended. The second illusion is the blind worship of market concentration. The most dangerous moment in investing isn't a crash, it's unwarranted confidence. Despite the geopolitical headwinds and the reality of sticky inflation, we saw retail investors earlier this year pouring their life savings into a handful of technology companies at valuations that defied all historical logic. Now we are seeing the consequences. U.S. stock markets have dipped for 4 straight weeks, but the real danger lies in the unprecedented level of market concentration. A massive portion of the S&P 500's entire value is tied up in a handful of tech giants. When you buy a standard index fund today, you're making a massive top-heavy bet on very specific companies trading at extreme multiples. When you buy a stock trading at 50 times earnings, you're paying for decades of flawless growth up front. With supply chains threatened and interest rates locked in the high threes, flawless growth is mathematically improbable. I want to buy wonderful companies when they're priced like average companies. Buying wildly overvalued assets simply because the price went up last month is not investing. It is speculation. And as we are seeing with the recent tech sell-offs, it is currently being punished. The third illusion is the hoarding of melting ice, saving fiat currency. The financial industry loves to sell you the illusion of the high-yield savings account. They proudly offer you a modest return on your money, and you feel brilliant for taking advantage of it. That sounds responsible until you understand the physics of fiat currency in an oil shock. Inflation over the past few years has been devastating. When a central bank expands the money supply to fund deficits, they do not create new wealth. They simply dilute the purchasing power of every single unit of currency that already exists. If your bank pays you a 4% yield, but the real rate of inflation is being pushed past that by $116 oil, your safe investment is generating a guaranteed negative real return. You are paying the bank a fee every single year for the privilege of holding your money while it evaporates. Cash is not a long-term asset. Cash is a melting ice cube. The fourth illusion is the ignorance of institutional flight. While the average retail investor is glued to the daily movements of the Nasdaq, the most powerful and systemic financial institutions in the world are executing a completely different strategy. They are quietly engaging in a massive flight to hard assets. Look at what global central banks have been doing over the last 2 years. They have been accumulating physical gold at a near-record pace. Why are the very institutions that create money out of thin air stockpiling a 5,000-year-old metal? Because they understand the mathematical impossibility of repaying global sovereign debt honestly in an environment of permanently higher interest rates. When debt becomes unmanageable, governments inflate their way out. Gold is the only reserve asset that is not simultaneously someone else's liability. When the architects of the financial system are buying hard assets, ignoring their actions is a fatal error. The fifth illusion is the false promise of complex financial products. In times of economic uncertainty and market volatility, the middle class becomes desperate for security, and the financial industry preys on that desperation. They sell complex products you can't explain in plain language: leveraged ETFs, structured notes, and buffered outcome funds with glossy brochures and clever names. A simple rule has served me well for my entire career. If you can't explain how an investment makes money to a bright 12-year-old, you're not investing, you're trusting. Complexity increases the chance you will be surprised, and it almost always hides devastating management fees that compound against you over time. Complexity is the enemy of execution. We have shattered the illusions. The comforting narratives of early 2026 have evaporated. You are now standing in the desert of economic reality. It is stark and it is unforgiving, but it can be navigated. If you want to survive this reality check, you must stop operating like a frantic, emotional consumer and start operating like a rational, heavily capitalized financial institution. You must adopt the architecture of accumulation. This is the exact protocol to build a fortress that cannot be breached by inflation or market corrections. Protocol 1. The eradication of destructive leverage. You cannot build a skyscraper on a foundation of quicksand. High-interest consumer debt, credit cards, personal loans, and auto financing is the deepest quicksand in the economy. The average credit card interest rate is sitting well above 20%. The stock market historically returns around 10% annually over the long term. If you are paying 20% on debt while hoping for 10% returns in the market, you are mathematically bleeding to death. You must attack this debt with unyielding fury. Downsize, sell what you don't need, and reclaim your monthly cash flow from the banking sector. Until your consumer debt is zero, you are entirely vulnerable. Protocol 2. The construction of the liquidity moat. Once your destructive debt is eradicated, you must build an impenetrable wall between your family and the chaos of the economy. Maintain at least 6 months of essential survival expenses in highly liquid form. I always keep massive amounts of cash available at Berkshire Hathaway, not because I love holding cash, but because cash gives you options when others have none. When the Russell 2000 enters a correction, or when the broader market drops because of a geopolitical shock, you do not panic. You do not sell your world-class businesses at a devastating loss just to pay for groceries. You live comfortably out of your liquidity moat, entirely detached from the panic of the masses. You use the excess cash to buy great businesses when they go on sale. Yes, this cash will lose some purchasing power to inflation. That is the cost of security and optionality. Protocol 3. The aggressive accumulation of the gap. Wealth is created in the margins. The speed at which you reach financial sovereignty is determined by one metric: the gap. You must spend less than you earn by a significant margin. The average household saves a tiny fraction of their income, keeping them on a treadmill going nowhere. Wealthy households maintain savings rates of 20%, 30%, or even 50% of their income, regardless of how much they earn. I still live in the same house I bought in 1958. Every dollar you spend on ego is a dollar that cannot work for you. Find ways to increase your gap by at least 10% immediately. Cut subscriptions, reduce transportation costs. The first $100,000 is the hardest money you will ever make. Get there as fast as you can and then let compounding take over. Protocol 4. The systematic execution of ownership. With your fortress built and your gap expanding, you must transition from a consumer of goods to an owner of production. You must own assets that produce real returns above inflation. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You must automate this entire process. Human beings are terrible at making consistent financial decisions when the news is terrifying. Set up automatic transfers so money moves to your investments immediately after every paycheck. Let the system do what you designed it to do. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. Protocol 5. The cultivation of the intellectual moat. The final pillar of accumulation is the one asset that no central bank can inflate away and no oil shock can steal from you: your mind. I read for hours every single day. This habit compounds exactly like interest. In the ruthless global marketplace of 2026, you are paid based on how much value you create and how irreplaceable you are. You must build an intellectual moat around yourself. Become deeply, painfully specialized in solving complex problems. Identify one skill that increases your market value and commit to developing it over the next year. Focus creates expertise, and expertise commands premium pay. The transition from a vulnerable earner to an untouchable owner is not a magical event. It is the result of thousands of small, boring, highly disciplined choices made consistently over a long period of time. It is setting up the automatic transfer into the index fund and having the stoic fortitude to never turn it off, regardless of what the Federal Reserve does or what happens with global oil prices. The reality check of March 2026 is here. The era of easy money is over, but armed with the truth, it does not have to be a tragedy. It can be your defining moment of absolute financial liberation.